morning and welcome to another edition of Friday's Financial Fitness. Today I'd like to talk about the concept of growth versus value investing. When you hear the term growth or value, what investors are really referring to is how the company manages their profits. In other words, when a company makes a profit, they can choose to do a couple different things with those profits. Similar, we also have discretionary income and we too can choose whether we want to spend it on things that we want or we can invest or save it. However, companies can't consume their profits, or hopefully not the ones that we're investing in. However, they can invest it back into the company or pay it out to shareholders. When companies invest their profits back into their own company in the form of research and development or new equipment or acquisitions of other companies, or sometimes it may just simply be them buying their stock back, we consider these companies growth-oriented. Growth-oriented companies may be growing at a faster rate than the overall markets, and most of their profits are focused on this growth expansion. It's often the technology and consumer brand companies that are growth-oriented. When companies tend to pay out the majority of their profits in the form of a dividend, we associate that with a value-oriented company. Because value companies pay out the majority of their profits, normally their stock trades at a lower valuation, a topic we'll discuss on another episode. These lower valuations are because investors don't anticipate as much growth from these value-oriented companies. Some of the common industries that are associated with value companies would include financials, energy, and telecommunications. You may be asking yourself, so what difference does it make, growth versus value? The importance of understanding growth versus value really comes down to performance. The performance of the two different asset classes can vary significantly. For example, during the tech run-up in the late 90s, growth stocks measured by the Dow Jones Large Cap Index did substantially better than value companies, which again measured by the Dow Jones Industrial Value Index. So from 1995 through 1999, growth was up a whopping 173% during that 5-year period. During the same period, value was up only 115%. Overall, still good return with value, but not nearly as good as growth. However, then in 2000, when we saw the blow up of the technology sector, growth stocks were down 28% and value stocks were actually up 8.6%. Growth and value stocks don't always move in opposite directions, but they usually have different returns. In summary, there are periods when growth does better than value, and of course there's times when value does better than growth. My philosophy has always been, have exposure to both asset classes, but overweight and underweight each asset class based on the current market condition.